Hello everybody, welcome to today's financial literacy lesson. Today we're going to be diving into the world of financial analysis. If that sounds complicated, don't worry, we're going to break it down into super easy to understand terms. So today you will have all the idea of how businesses evaluate their financial health. So the first step we'll be looking at is financial ratios. Well, the first type of ratio is liquidity ratio. These tell you if a company pays off its short-term debts, kind of like checking if you have enough cash to cover your bills this month. Then you have current ratio. This one compares what the company owns right now or to what it owes in the short term. A higher ratio means the company is in good shape to pay off its debt. Then for example, imagine a small grocery store with $10,000 in cash and $5,000 in bill to pay. Its current ratio would be 2, meaning it has twice as much as it needs to cover its bill. That's a good sign. So then you have a probability ratio. This shows profitability ratio. These show how efficiently a company is making money. Basically how good they are at turning sales into profits. So the net profit margin, this ratio tells you what percentage of every dollar earned turns into profit after all expenses are paid. Then you have efficiency ratios. These measure how well a company uses its assets, like checking on how often a store restocks its shelves. So this ratio will always tell you how many times a company sells and replaces its inventory in a year. Then you have leverage ratio. These ratios tell you how much of the company's money is borrowed. Debt to equity ratio will tell you the company's total debt to the money it owns, the money owners have invested. So then you have performance evaluation. So the steps in doing performance evaluation. The first step is to reviewing financial statements. Look at the company's income statement, balance sheet, and cash flow statement, like we learned in our last lesson. Then you want to calculate financial ratios. Then you want to compare with other industry benchmarks. See how this company stacks up against the others in the same industry. Then you want to analyze more trends. Look at financial data over multiple periods to spot patterns. Then you want to identify areas for improvement. Use your analysis to figure out what the company could do better. Let's say a local restaurant does all this and discovers it's doing well, but its inventory turnover is high. This means that the restaurant could improve by managing its inventory better, reducing costs, and increasing efficiency. So there you have it. Financial analysis might sound complex, but with the right tools, it's really just about understanding the numbers and using them to make smarter decisions. Whether you're running a business or managing your personal finances, mastering financial analysis can lead to greater stability and success. Thank you for watching.